So my name is Emily Cortright, and I am the Wealth Ambassador for the office and for pretty much the DFW region. So what does that mean? That means that I go to the KW Wealth Masterminds 3 times a year with some of the top investors throughout KW, and I get to learn about wealth building, about investing strategies, about what Gary Keller is doing with his wealth, what Brett Tanner is doing with his wealth. And my role as the ambassador is to bring back the material to our offices, to our agents, and to our communities. And so this is a great example of that, because over the past year or two, there have been a couple conversations at KW Wealth that have talked about life settlements. And I had no idea what that was before, but we were talking about Gary Keller's portfolio, and they showed a pie chart that showed he has 11% of his family office invested in life settlements and life insurance products. And so that is huge. His family office is a little over $250 million. And so that is a significant amount invested in life settlements. Brett Tanner, who also runs KW Wealth, is also invested in life settlements. But it always felt like something where there wasn't a lot of information given. There was never a guest speaker brought in. There was never a referral made. And so as Adam and I, my husband and I, were talking about our investing strategies this year, we had some money come into our Roth IRA, and I said, I want to learn more about life settlements because I keep hearing about them and I don't know anything about them yet. And so we put a post on Facebook to our network, and 2 referrals came in for Dirk and Terry's company, which is conveniently local here to Southlake. And so we knew two of their past investors that were very happy, and we scheduled a meeting with them. We sat down, we learned about the product, we investigated the product, we investigated the company, and we decided to make an investment. And so as part of that learning experience, we've been really excited to share some of the information we've learned. So I'm happy to answer questions from my end, but Dirk is the expert in the industry, and we're really lucky to have him local here to Southlake. He has his team member Jennifer here with us today as well. So if you have any questions, they're here to answer them. And so I'm going to pass it off to Mr. Dirk Davis to teach us all about life settlements.
Good. Thank you. Well, thanks, Emily, for the intro, and thank you guys for having us. Thanks, Keller Williams, for letting us come and speak to you guys. Life settlements, our company is pretty small, and really life settlements is all we do. We're a niche company, so we specialize in this type of investment, and we don't do anything else. We just continue to do the same thing year after year, just providing investment opportunities in this area. So I guess, so I'm going to start off just talking about what a life settlement is. It's really pretty simplistic. It's not complicated, at least I don't think so. It's a real simple concept, real easy to understand. The term life settlement, it's created when an individual who owns a life policy, whether it's a term, a universal life, or a whole life, when they sell that policy to a third party, once that transaction happens, then it becomes a life settlement. It's just that simple. So you have an individual who owns a universal life policy, and then for some reason, there's a myriad of reasons why they would sell it. They decide to sell it, and they find an avenue to get that sold. And once that happens, they've created a life settlement. So it's pretty simple transaction as far as doing that from the policy owner and the buyer. So you can buy it directly, and you can use an attorney. So let's just say Mr. Jones wants to sell it to XYZ company. They can make a contract, they can get an attorney, and they could sell it, change over the ownership. They can be done that way. However, we prefer to do it through what's called a life settlement provider. Since you guys are all mostly realtors, you understand the importance and the function of a title company, how it is involved in a real estate transaction. a life settlement provider does a lot of the same things for the life policy transaction. So we use a provider out of California called Montage Financial Group. They're really experienced, one of the top providers in the country. They provide a lot of services to us, but mainly in the closing of the policy. So we find a policy we like, we put in an offer, they accept, then we go to Montage. Montage does extensive due diligence. They look at the policy from application all the way up to its current status. They look at the medical files, they look at everything, and then they say, kind of like exceptions on a title policy, they'll say, hey, here's a couple things you want to look at. If it bothers you, you need to address it. If not, move forward. So they do a great job in helping us. We do our own due diligence, but we use Montage. They provide about a 70-page closing package when it's done. So I'm going to have Q&A at the end. Sorry. So we'll have, so when we close that policy, we escrow the funds with Montage. Then they do all the changeover paperwork with the carrier. And then once it's all been changed over, they release the funds to the seller. We own the policy. But it's a great tool for us just to do a clean transaction with a great amount of due diligence. So as our company, we do all of our purchases through Montage, and that just gives us that comfort level of due diligence. Occasionally, in the past, we bought some direct through our attorney, which it still is a good process, but we like to do it through Montage. Just to give you some statistics, I think that are kind of interesting about life settlements. 88% of all policies, term, whole life, universal life, 88% of those either lapse, expire, or surrendered. So in other words, only 12% are paid out. So you probably can relate to that in your own life experience, where you've bought a policy and you say, I don't really need that anymore, or the premiums have gone up too much, I'm just going to let it go, or you'll surrender, get your cash value out if you have any. So that's what happens to 88% of all policies. They just are lapsed or surrendered. Another thing too is when people sell their policies, on average, they're getting about 4 times their surrender value. Let's say, just for an example, they got $1 million policy and they've got $50,000 built up in cash value. Statistics say that on the average, they're going to get $200,000 when they sell that policy. So they're getting about 4 times, what they could surrender that. That's, and that's why, a lot of people prefer to sell it, the ones that know about it. Another interesting statistic is about 200 billion in life policies, will be actually lapse or surrender on an annual basis, projected through 2027. So they're projecting like every year 200 billion is going to be surrendered or lapse. In other words, they're just disappear. They're part of that 88% that never gets paid out. I guess in the United States, most people, which they're saying about 55%, most people don't even know that you can sell a policy. I mean, so, you get, this is a real scenario. It's how we acquire a lot of policies, is that, Bob and Martha, I hope none of y'all are named that, but Bob and Martha, they've got a $5 million policy, or maybe they've got 3 of them. They're wealthy, and they've got 3 $5 million policies, and they call, their agent Ron and say, hey, Ron, talk to Martha. She doesn't want this policy anymore. We're just going to let it lapse. The premiums are about $200,000 a year. That's, we can save that cash flow. We've got other policies. And the agent will say, well, hey, Bob, didn't did you know there's a secondary market? I can sell this policy for you. Oh, really? You can actually sell it? Yeah. So agent gets out there in the life settlement market, secondary market. He starts trying to sell the policy. Next thing you know, they've sold their policy for $350,000 versus just letting it lapse, being part of that $200 billion that goes away every year. So a lot of people just don't know that they can sell their policy. Another, one thing about selling your policy, I don't know, you guys may have seen this if you watch the news, or there's a company called Coventry. They're just one of many brokerage houses that buys policies. So you watch their commercial and, you see grandma and grandpa walking through the backyard. Did you know you can sell your life insurance policy? So they have that commercial. So Coventry is a huge brokerage house, and they buy millions of policies. But what they do is that they'll talk to Bob and Martha and say, hey, we'll give you 5 cents on the dollar. And they're like, oh, great. And then the next thing you know, they bought it for 5 cents on the dollar. They mark it up to the market, and then they'll sell it to hedge funds, institutional buyers, and they'll sell it at market, and make a huge profit. That's
Predatory.
kind of predatory, but there's companies out there, Coventry, Lighthouse, Abacus, just name a few. They're huge companies. When we first was trying to get into more institutional marketplaces, we talked to Coventry, and they told us right up front, you're going to have to buy the cheapest we'll sell a policy to you is 14% return, regardless of what they paid for it. They're going to make 14. We're going to sell it to you at a price that you can make 14% at the most. And that just didn't really work for us. Didn't fit our model. So we bypassed, all these brokerage houses. So our sourcing is a little different. We develop relationships with individual agents and individual brokers, not a brokerage house, but a broker who also has a relationship with an umbrella of agents. And so we just deal directly with the broker or the agent. And most of ours comes from agents, not brokers. So we deal directly with the insured through the agent, and we cut a purchase agreement with them. And not to say we're not trying to buy it cheap. We are. We're no different than Coventry. We're trying to get it as cheap as we can. And there's really one thing about a lot of markets, there's a lot of efficiency in the market. In other words, the market is very efficient in its pricing. One thing about life settlements is that in buying life policies, it hasn't reached efficiency yet. So you can find deals, if you want to call it that, out in the marketplace with people that, for whatever reason, you make an offer, they take it. But what we like to do, which I'll talk more a little bit, in our offerings, we try to pay as little as possible for these policies so that we can create opportunities for our investors to make the best return. Because if we can't provide great returns to our investors, then, we're not going to be in business very long. So, yes, we do try to get them as cheap as possible, but we also try to create a big margin for our investors. And, I'll talk about that in a little more. They say that the life settlement industry is growing at about 34% a year. I'd say our company's growing, at a similar rate, but it's a growing industry. Just to let you know, Berkshire Hathaway, Warren Buffett, they're the largest holder of life settlements in the world. I don't know how large their portfolio is, but it's very large. And so that just gives you an idea of kind of the marketplace. I haven't done very good on my slides.
Go a few more.
And Emily put these together when they were great because she has a great understanding. She has a great understanding of the product. So I was very appreciative of her putting these together, and but you can kind of see that yes, obviously the targeted client to buy a policy is going to be an older individual, generally with health impairments. Because let's make no mistake, the investment is about them dying and collecting the benefit. As morbid as that sounds, it's business. They sell it. Like I said, on the average, they're getting 4 times what they would have if they surrendered the policy. So they're getting a great benefit. The only person that maybe loses is the life insurance carrier because they're counting on them being part of that 88%. So when they sell their policies to a company like us, we're going to see it through. We're going to collect that claim. If it takes 2 years or 10 years, we're going to see it through and collect the claim. So yes, do the insurance agency carriers like Zurich, Lincoln, John Hancock, those type of carriers, do they like life settlements? Not really, because, we are messing with their mathematical model, and by taking these to maturity. So that's really the type of policies that we're looking for. One thing we do is when we get ready to buy, we're not buying 365 days a year. We buy, we put an offering together, we put it out to our investors, and then we get back in the buying mode, then we'll buy. But when we do buy, we cherry pick a lot. In other words, we look at a lot of policies and we'll like, no. Oh yeah, this one works, And when I say works, it works out mathematically. And sometimes because we deal with agents and individual brokers, we do occasionally get information about the insured that we wouldn't get if we went to a brokerage house. So Ron, the agent, may say, old Bob, he's going to sell his policy. By the way, he's suffering from A, B, C. I see him at the country club. He's getting drunk every night. He's not taking care of himself, whatever. And, he says, I think he's one that you might ought to really look into, So we get a little bit of that. We kind of take it with a grain of salt because the agent's also selling. So, we wade through that. But it is information that we can gather and obviously kind of use in our analysis. And that's why we like to deal with agents and individual brokers because we get a little bit deeper dive into the insured. Yeah, one of the things about this investment period that's great, and is that there's really no correlation to any market. In other words, if there's a real estate bubble, which you guys are all familiar with, if there is a stock market crash, like we had in 2008, if there's a 9/11, if there's oil and gas prices are low, interest rates are high, all of these calamities in the marketplaces, they don't affect a life settlement because it's not correlated to anything. Now, I guess higher interest rates could cause the insurance companies, because they're paying out higher rates, they may try to raise their premiums, which they can up to a limit on the policies. That's one correlation, I guess, that you could actually make. But in general, there's really no correlation to all these bad markets. The only variable in life settlement investment that you have to deal with is time, because God only knows when that person is going to settle, and that's the word we use. We don't say die, we say settle. When they settle, that is the only variable. When are they going to settle? We do an extensive work on trying to figure out when that's going to happen, but obviously that's way beyond our control. So as much work as we do, we put into analysis, looking at medical files, looking at family history, social history. We look at all those things on the client, and we come up with, and we actually hire a third-party company outside of us that gives us their opinion, and we use a doctor-based group. And so they basically do what's called a life expectancy. And that's kind of, they underwrite the insured, and then they'll give us their best guess on when they think that person is going to settle. And so we kind of use that as a baseline in our investments. And they're not accurate. I'm going to tell you right now, they're not accurate, because what I've learned is about a third settle early, about a third settle pretty close to when they thought, and about a third goes long. And again, that's where the variable of time comes in, because you don't know. Going long could mean 10 years. I mean, you never know about how long people are going to live. But that's why we buy policies, generally older individuals with health impairments. And those, that's the type of product we use in our offerings. So I had a guy the other day was trying to sell me a policy for a guy that was 67, and he's got some little heart stuff, but so I'm saying, well, that guy's going to live he's going to live another 15, 17 years, probably. I can't use that product. So that's kind of how it goes with us. And at the same time, he said, well, I've got a female who's 86, and she's got extensive heart problems, congestive heart failure, all these things. And I said, well, I'm more interested in that one, And so, I mean, that's kind of how it goes, with us when we're looking at insured. And it's not a perfect science, but we try to get it, the best we can. So that's really,
Dirk, before we move on from
Yes.
the basics,
Let me turn this back on real fast.
one thing to make sure to note is that the investor now is responsible for those annual premiums. That's a really important
Yeah.
thing, because that's part of the investment. So if you touch on that?
Yeah, once that Montage makes that change over at the carrier, that next monthly premium has to be paid, and we have to pay it. And so, the way we do our offerings is we put our own money out, we buy the policies. So we're at risk right away. We buy those policies, we have to make that premium payment the next month. So we start paying that premium. So we have to have our offering together, get it sold, recoup that money, and then once we sell the offering to the investors, then they are, as Emily stated, they are definitely responsible for that annual premium. And that's what Jennifer does for us a lot, is she does our billing and collecting. So in other words, we've got around 1,300 accounts. At some time during the year, they're going to get a capital call for their share of the premium. And that's we give them 2 months, we mail it out, they have 2 months to pay it, and if they don't, then they get Jennifer on them, which you don't want that.
But that is known from the very beginning, and it is part of the offering package to say exactly what the annual contribution will be. And we'll see an example at the end.
Assuming your factor about these deals, like you're not taking a policy down by yourself, say you're Apple, or your policy per se, or above government. What's the security there, on a cash call like that every investor is going to pay? Short premium, and that's policy last year. So.
Yeah, there's generally, if we have an investor, which this happens occasionally, which Jennifer also handles this, if let's just say some investor says, hey, my financial picture's changed, I can't be a participant in this, I can't afford the capital call anymore, or I just don't like it anymore and I'm going to quit. Well, in that regard, they lose their investment. They can sell it, and if it's an accredited investor, they can sell it, replace that investor if we approve the investor, which normally we do, or they just walk away from it. They just lose their investment. Then what we do is we resell it, and we have several groups that are always ready to buy an investment that somebody's walked away from because they're getting it at a discounted price. So it's really easy for us to sell those. We've never had an issue when somebody drops out, which we don't have that many over the course of a year out of 1,300 accounts. But the ones that do, we just put them in somebody else's hands. And
so you're securing it essentially, and then you're finding the puzzle piece that needs to fit in there.
yes, I mean, we'll replace that investor. And usually it's a very small percentage of the overall capital call. So you have 100 investors in one of the offerings, and over the course of a year, you have one who drops out. We replace them, and we just keep going. Now, I guess, if you want to really get dire, you get into a situation where it gets really long in the tooth, and you have more people wanting out. We still have bigger, more institutional, or I'd just say larger investors with deeper pockets that'll take everything. So we're fortunate that we can do that, to where we can replace, even if 25 people dropped out, we can replace that. But that's never happened. We've had onesies and twosies over the years, but never a massive exodus or anything like that. I'm going to leave this slide up here a little bit. And if Jennifer's going to pass out just kind of a brochure of our company, I just want to talk about our company just briefly, who we are. We're, there's all kinds of life settlement companies, and they offer all kinds of products out there. We're very small comparatively, kind of like a boutique little life settlement company. As I said in the beginning, we do nothing else. This is all we focus on. My partner in crime is Terry Holland. Terry has been in the life settlement business for, I'm going to call it 20 years in various capacities. Started out as he was with a couple of his buddies. They were sitting around a table, and they said, how can we deploy capital? And somebody said, I've heard about this life settlements. This is 20 years ago. And they found a life settlement company in Oklahoma. They began investing in that. Then Terry began to work with them a little more as far as finding policies, providing financing. And then he eventually took control of the company because he needed to, for some of their practices weren't the greatest. So he took control of the company, and then it became LIMC, what it is today. I joined Terry probably about, I was trying to think how long ago before I spouted off. I think it's about 8 years ago, roughly. I'm an ex-bank CEO. That's kind of my background, banking. And I got out of banking, ran across Terry. I immediately fell in love with the life settlement investment, the simplicity of it, and the opportunity that it provides. So we kind of joined forces, and we built up LIMC now to where, if you'll look, on the little brochure that Jennifer had, we manage about 133 million in assets. It's not huge. We have 142 investment partnerships that we manage. And some of those are a little small, maybe just 10 members, and some of them are larger with about 280 members. But we have 142 of those partnerships that we manage. Those partnerships own a piece of a policy or several policies. We have 105 insured that we're managing right now, policies. And, you know, to date, our average internal rate of return on the settlements that we've had to date is 39% return to the investor. That's not always the case. I mean, you can look, I think on the inside of this, like right here, it kind of gives our performance. And that's kind of the beauty of live settlements, is that some of them do great and some of them don't. It's all tied to that variable of time. And so that's why we like to do an offering. We like to put at least a minimum of 3 or 4 up to about 10 investors in an offering, because that kind of mitigates the risk. So if you've got one person, if you just, you know, the company that Terry took over, they did a lot of just single policy partnerships. In other words, you put all your eggs in that one basket, so you're just relying on that one insured. Well, you know, we've got a insured named Fred Womble, and this was before our time, and his agent called me and he said, "Hey, Fred might want to buy his policy back. You guys be willing to sell it?" We're like, no, we can't. We've sold it out in an offering. Oh, okay. Well, he just got remarried to a young lady, and he
know where that's going.
He's reinvigorated. You know, his life is you know, he's very healthy. You know, whatever. He's trying to sell me on the fact that, you know, even though he's 80 years old, he's got a new lease on life. But so that's why it's really unpredictable. You know, when they bought that Fred Womble policy, you know, it looked dire for him. So things can change. You know, it's just the nature of life. But so that's, you know, as a company, you know, we generally do 2 or 3 offerings a year, anywhere from 3 to 10 policies in there. And, you know, that's all we really do. I mean, Jennifer can attest, she does all the billing, collecting every month. She's sending out capital calls and collecting those, among many other things. But, and so we have a very simple concept. And you know, our, I guess probably, you know, over the course of time since we've been here, we've had 24 settlements, I think is what we've had. And like I said, the average return on those is 39% to the investor. But we've had some singles that have been, you know, single digits, a single policy offering. So that's why, kind of since I joined the company, we started building these multi-pack offerings where it mitigates more risk. But we, as I said earlier, we really just, we deal strictly with agents and brokers. We really work hard to find policies that we think will really work. Not that we're always right, but we do a lot of due diligence with our agents and putting an offering together. As Emily said, we do office right here in Southlake, and I think we're kind of winding up an offering right now. But I guess before I kind of move into that and to talk about an offering, the current offering that we have, you know, I would open it up for any questions about live settlements or about our company, what we do and how we do it. I'd be glad to answer anything. Sorry, go ahead.
Oops, sorry, was that?
Yeah, you go ahead. Yeah.
So what are the tax implications?
That's my question.
Tax implications.
the settlement or how it's done that?
Yeah. It's the way it's structured right now, it's ordinary income.
Okay.
But, I can tell you a short story, which doesn't matter to you, but it's frustrating on our end, is that prior to 2018, it was the way we structured them, and we still have a lot of our offerings grandfathered in this, where they're tax-free. And the way that we could do that was, if we bought Bob's policy, we would make Bob part of the LLC that was buying the policy. He was a preferred member. So without getting into a lot of details, what that did was it was a transfer of value. So the non-taxable death benefit of his policy would transfer into the LLC. And so we have, I would say, over half of our policies are under that structure that we're managing right now. However, back when Trump was president in his first term, they did a minimum wage bill. As part of that minimum wage bill, the Senator Orrin Hatch, I don't know if you all ever heard of him. Orrin Hatch, he's a senator from Utah. He was retiring. He was getting out of politics. He submitted on that minimum wage bill a language that basically changed that tax structure, which essentially said, yeah, you can do that, but only if you are related to the insured or you are already business partners. So every policy, they grandfathered it, or they made it retroactive, I should say, back to 12/31/18. So all policies purchased after that are subject to the new wording in the tax law. So it pretty well, there are some really creative ways you could probably get there, but it's just nearly impossible to explain, and you have to work in an the annuity world to get there. But so lo and behold, yeah, it's back to your original question. It is taxable as ordinary income.
So is the 39% taking into taxes, or is that?
That's pre-tax. Pre-tax.
And that's one of the reasons that I invested through my self-directed IRA, because I knew that it's a Roth IRA. It would avoid the taxes altogether. But in doing that, in this fund specifically, I had to make sure that my IRA can afford the $5,300 a year annual premium. And if you get more into the details, that annual premium does go down as people expire, because when one person expires, well, now you're only paying 2 annual premiums. And so that whole schedule is published of here's what it's expected to be in year 2 and 3 and 4. Just something to keep in mind. If you're going to invest through an IRA, you don't want to take the last penny out unless you can put in a contribution.
So you're saying that the annual premium can be funded by the self-directed IRA?
Mm-hmm, it is, because my investment is through my IRA. Yeah. So my IRA is going to make that annual premium.
The initial share is the investor share, the $46.77, and then the annual premium
all comes.
And then that leads to the next question about the life expectancies. If the first 2 people settle in 2 years, then I would assume the annual premium would
go down.
Yeah, once that policy is claims paid, and obviously it's over, there's no more premium. But on the other flip side of that is that the premiums are increasing annually with the insured. So what we buy is universal life policies. I don't know how familiar you are with life insurance, but obviously term, you pay a flat fee for 10 years, 20-year term, whatever you get. Universal life, or let me jump to whole life. Whole life is a planned premium that is not flexible, and you pay this planned premium, which includes money that's being invested for you into the life insurance company. So part of your money goes toward death benefit coverage, the other part you're investing with the life insurance company, and that's not flexible. That's a planned premium. It's a whole life policy. A universal policy has flexible premiums. In other words, you can pay the planned premium, but if you don't like it, or you don't want to put your money with Lincoln Financial through a life insurance policy, you can just pay the cost of insurance. And then, but in doing so, that premium's going up, depending on the insured, anywhere from 5 to 8% a year. So that's what we do. We buy universals. We have that flexible option, and then we pay the bare bones minimum, whatever it costs to keep that policy in force. So every time we send a capital call out every year, it's going to be a little more because that premium's gone up 5 to 8%, you know. And so we do that because it keeps more money in the investor's pocket and not in the insurance company's pocket, because they basically take your money and they reinvest it into other things, making more money than they're paying you. It's, you know, you well know. So, but yeah, that's the way it's taxed, is ordinary income. I know you had a question. Okay. Yeah, it's, I think some policies, we will look at a term policy only if it has it's convertible to universal life. So once the term's up, then it converts, and we'll look at that. But I think 99% of our policies are universal life.
What's going to be my question?
Yeah. Yeah, that's the only way we'll buy one, because we need that flexibility, you know, for premiums.
You do it through your self IRA. Can you do it through a SEP? You can't you?
I think you can. Yes. I think we have some that do that.
And just to backtrack one more slide, let's talk about the benefits, because this is in the example specifically. So each share is the 46,000, and when I say predictable returns, we know that each share in this particular fund will return 108,000 once all the three policyholders expire. What is unknown is how many years that's going to take to happen. And so that is the longevity risk, is how many years do I need to put in the $5,000 a year? And if in the offering documents, you'll see the break-even point. Like if all three people live 10 years, then it's break-even. So you'll see kind of the sensitivity analysis in the documents, but you'll also, and I kind of read your eyes when he was talking about the life expectancy reports, you get to see the life expectancy reports for all the policyholders that are in the fund you're considering.
It'll scare you, I'm sure.
Actually, Emily, we're going to pass out the current offering we have now. So then I'll kind of go over the offering now, so you guys can kind of see what we really are doing with an actual offering.
Yep. And then the only other point that I wanted to make is just, this is the opposite of a cash flowing investment. This is, you expect to be putting money in each year until the fund is over. And so it's just a different structure than a lot of the investments that we do talk about.
Yeah, one way I like to pose that is that you're essentially just moving savings dollars from one vehicle to another. You know, a lot of people think, well, that premium is an expense. Yes and no. It is an expense, but it is already part of the investment. So you're moving dollars that you have in maybe this savings vehicle over to another one, which is part of the overall investment. You know, it's a lot of people are like, oh, well, I invested this originally. These are just expenses that I have to pay. Well, no. You know, it's just premiums that go with it. That's part of it. Now, what Jennifer passed out, and I think Emily has this on her slide, some of the details of it, is that this is our current offering. It's called Argyle policies, and it has three insured. And we bought two of these policies from an agent, same agent, and we bought one from a broker. And so we have pretty good knowledge of two of these insured. So as it shows up here, a 1 unit cost. So the offering is $4.6 million, and we have 100 investment units in that. So each unit is $46,777 for 1 unit. And we put this offering out around the 1st of April, and we are down to almost single digits, left of units available. So if you look at this, what we like to do is there's a summary page. It looks like this. If you can see it, it kind of just describes, it gives you it really kind of gives you everything you need to know about it almost. It kind of gives you the age, the life expectancy of the individual. Kind of gives you a little summary of their medical issues, and it tells you what the death benefit is for that insured. So it adds up to $108,500, but it breaks it down per insured. So what happens is if one of the insured settles, you get paid immediately for that. You're not waiting till the end. A lot of people think, well, I have to wait. No, you get, as soon as that claim's paid, that money is dispersed to the investors. So you get $40,000 for Levine, $22,500 for Cook, and $46,000 for Van Boyne. And it also kind of gives you the projected individual return for each policy. If they actually, these numbers are based on them settling on their expected life expectancy. So if their life expectancy for Levine is 21 months, I guess he's probably the one we have the most knowledge on. He's suffering from what's called Lewy body dementia. He's 24-hour care. He's in stage 7 of 7 stages of that disease. So his it talks about his LE's 21 months. Cook's 22 months, and Van Boyne's 58 months. So when you flip that page over and you get over to this first little cash flow, it kind of shows you how that 46% has arrived at, because this is basically projecting putting your $46,000 in, paying your capital call annually, and also receiving your death benefit as projected. So if everything just went off as clockwork, 21 months, 22 months, 58 months, you're going to make 46.68% on your money as a return. Now, obviously, we know that's not going to happen, and they could settle early or later. So that's the one variable that we talked about is time. So one thing we do like to do, it's mentioned in the body of some of this spreadsheet, but what we do is like to say, okay, what if all 3 of these insured, they live 50% longer than projected? What's that return going to look like? And the reason that we project such high returns is because we know that it's not a perfect science of predicting death. So we like to have a lot of margin. So, okay, you didn't make 46%, but let's just say that if all 3 of these insured live beyond their life expectancy and they go 50% longer than projected, you're going to make roughly 16%, which is still not a bad return in today's world. So we like to show that so the investor can think like this: okay, if everything goes according to plan, I'm going to make 46%. If they all live 50% longer, I'm going to make 16. So it kind of gives you just an idea of what you're getting into, kind of some of the things that could happen. But like I said, a little while ago, our experience is about a third settle early, a third settle close to on time, and a third settle late. But that's no perfect science. That's kind of the averages as we've gone along. So as you can see, if everything goes to plan, you're going to make 46%. And we like to put this, because we do this little information package. The other spreadsheet we got in there, which I don't really like, but we have a lot of clients in Louisiana, especially in the New Orleans area, and they like this spreadsheet. And so what it basically says is that if they all live 10 years, so essentially it's going to take, it's really going to take 9 years to go negative. So if they all were to live 9 years, your death benefit is going to be less than what you've paid into the investment. So you can kind of track that. The only thing I don't like about this little spreadsheet is that it assumes everybody dies the same year. So year 1, year 2, they all die. What am I going to make? Year 3, they all die. What am I going to make? So it's kind of unrealistic, but it does kind of give you an idea of how the premiums do go up. So if they're all still living, you can see how those premiums are going up every year. And that's real. They do go up that much. So it's just another way to look at it, kind of give you another piece of information so you can analyze this, kind of see how, some of the things that could go wrong, the pitfalls, because, I don't want to sit up here and tell you that, you're going to make 46%, everything's going to be great. You could make more, but, we try to give as realistic looks as we can. And then you kind of move on, and you can see these clarity evaluations are redacted with some of their personal information, but it gives you kind of the report that we get. Well, they may look at 1,000 or 1,500 pages of medical files, and then they summarize this for us into a nice little report with their professional opinion. Clarity is a doctor-based group, actually here in Texas, and we've used them for a long time, but there are probably 25 of these type of companies out there.
Did they just do a search on Social Security number?
For this information? No, the actual insured provides us with all their medical files or access to them. We sign a HIPAA, and they give us access. We contact the doctors. They just send us all their files. So then we provide that to this company, and it takes them about a week, and they'll turn around this report for us. And then, of course, we look at it too, and then knowing the agents, we get a little inside information that I really don't like to share too much with clients because it's hearsay. Well, the agent said, he's about to die. Well, all of a sudden he lives 10 years longer. What happened there? So I don't really, I just take it into my own account. I really don't like to share it with investors too much. Yes, ma'am.
How accurate do you find this a premium analysis that is the projected?
Pretty accurate, and I'll tell you why now, because we use a third-party company also that does what's called a premium optimization. So what they do is we give them access or authority to talk with the carrier directly on our behalf. So what they do is they get with the carrier, and they specialize in this, so they know all the right questions to ask and how to drill down and get the cost of insurance so they're accurate. And so what they do is they give us, like age 100, the actual premium outlay, and they're for the cost of insurance only, and they're very accurate on it. So if there's ever a dispute, let's say, well, the optimization says it's $20,000 a month, and the carrier says it's $22,000, so we call COVA, hey, your report's off. So they call the insurance carrier direct, and usually they're right, the carrier's wrong. That's what normally happens.
Takes on the liability of the discrepancy.
Well, yeah, there's no liability because if you read your investment docket, it says these are estimates. Okay. So at the end of the day, yes. So let's say premiums are more than what we're projecting, which I wouldn't like, if I'm an investor, but they are estimates to the best of you can actually estimate. Because this company, Colva, that does this is all they do. They're very good at it, and they give us, a detailed report. Not to say they couldn't be wrong, but anyway, we've had good luck with them.
And
Yes.
I have actually a license agent as well, but like
Yeah, awesome.
it gets complicated with like the terms and stuff like that. Like universal life invested, basically where you're buying. I really looking at like the part A and part B of like the actual.
Yes, yes. And in most every policy is option A. Yes. Yes.
Lapse if they don't pay the higher premium. That's the in part B. So that's why I was wondering the cost that or
Yeah, I mean, well, it's for what I'm talking about. Option A and B is the cash value option, where if if there is cash built up in the policy at death, they lose it. Yeah, that's 99% of our policies are that way. But what we do, though, just so you know, is that if say we buy a policy from Bob and for some reason he sells it to us for $300,000, but he got $175 in cash value in the policy. So what we do is we deplete that immediately into premium payments. So what we pass that on to the investor. So $175,000 in cash value, we tell Lincoln Financial, hey, pay the premiums out of that until it's depleted. And then, and we know that, and so we have that in our premium estimations. But
yeah, that would be just right here on the spreadsheet.
mm-hmm. Normally, when we get a policy, it rarely has cash value, because a lot of these people, a lot of our clients are older, wealthy people that have multiple policies, and they are liquidating some of their policies. Yeah, and so what they had done is they put in one lump sum, and they let it carry out until it's depleted, and then they decide either they're going to put more in or they're going to let it lapse, or if they find out they can sell it, they'll sell it. But that's normally the case. So when we get them, it's really rare there's cash value. And we don't build up any because we pay the bare bones cost of insurance.
Now, kind of silly question.
Sure.
Numbers, split. How long does it take for us to find out he's dead?
How long does it take to find out?
Because he's in another country, and
Yeah.
do you think there's did he just kind of fall off the radar?
Well, we have a service that we pay. No, well, we've got one right now. We're thinking about hiring a PI just to go investigate because there's something fishy going on. We feel like, but anyway, that's another story. We won't get into. But we have a service that basically monitors their Social Security number and also monitors the obituaries, which really that's where you get a lot of information. It comes from an obituary. So we have a service and they also reach out to the insured periodically, and they're confirming their address, they're making contact with them. So they provide all these services for us. We pay them a monthly fee or on a per insured basis. And so they're constantly monitoring everything that could be monitored to see if somebody is alive. They're monitoring it, and they report to us. So normally they give us a report every week, so we catch, if there's a death, and we find out about it. And then what we do is we try to contact the family, the beneficiary, if they had, because sometimes when we buy a policy, as an incentive in buying it, we will leave part of the death benefit with the insured's beneficiary. So it might be as small as $5,000 or it could be $50,000. So that gives us a direct link to that person as well. It also is incentive for them to call us. Hey, my grandpa died. I get $5,000. When are you going to send it to me? So we do that for that purposes. But we monitor it, and once the claim's filed, it usually takes, I'd say, 3 to 5 weeks, depending on the insurance company. It depends on how fast we can get the death certificate. A lot of times we just call the funeral home. Hey, we need a death certificate. So the sooner we get the death certificate, the faster the claim's filed, the faster we get the money, the faster the investors get it. So we're always trying to expedite that. Yes, sir.
Next question. So your company's buying the life insurance policy from the insurer. So does the company then take place of the insurer?
The entity that owns the policy takes the place of the owner, but not the the insured is still the insured. Yeah.
Income that comes off.
Oh, absolutely. They forfeit.
Policy.
Yeah.
Yes.
Right.
You said they were ordinary income.
Mhm.
So well, I said because so if you're taking the place, it seems like it would just be in exchange about getting tax-free income. But if it's ordinary income,
Mhm.
I'm trying to say, is this a security that's being sold? Because if it's a security, then I would go, well, why isn't that capital short-term?
Yeah, I wish you were right. I wish it was short-term capital, but our offerings are registered with the SEC as Reg D 501 B, and so it's investment income, and it's ordinary income, but once we buy the policy, we lose a tax-free benefit. It comes into the entity that owns it, and basically the policy itself comes in and it's taxed as ordinary income to the LLC that owns it, which then the members of that LLC also, the income that they make off of it is ordinary income. They'll get a K-1. So as an investor,
Income stream is just
exactly.
ordinary thing. That's us.
Exactly.
Only is history like you would a mutual fund or stock.
Yeah. So like if you were an investor and there's a settlement and you get, the death benefit check, at the end of the year, you're going to get a K-1 that reflects your net income as a partner in the partnership, a member. So, another thing I didn't mention, I just thought of, I'll get right to you just a second, is also, even though this is ordinary income, let's say that the cost of the offering is $4.6 million. Now, part of that is the first year premium. So when you pay that $46,000, you're also paying the first year's premium for those three policies. So the cost of the offering less the premium. Let's say the premium's $1 million, just to make it easy, but it's not that much. So let's say, then the cost of the offering less the premium is $3.6 million. So there's 100 investors. So that first year, let's say there's no settlement at all. You're going to get a negative K-1 for about $36,000. So that's also, you can also use that in your own personal taxes. So you get that tax benefit.
You get that tax
of the
year 1, 2, or 3.
Yes.
Like settled, you're going to get taxed on the full.
Exactly. So you kind of get it both ways. You get the benefit of the loss or the cost of the offering the first year, maybe this part of the second year, and then from that point on, as income comes in from death benefit, then you'll also have to pay taxes on it. So,
Can you just could you restate what?
Yeah.
I understand even the initial investment with forcing stuff, and it is going to be on the K-1 will be a loss.
Part of it, everything but the premium. The premium is not part of the loss. So, what's included in that is cost of the policies, cost of closing, all the expenses associated with it, everything that's associated with putting the offering together and buying the policies. That part, you'll get a K-1 that reflects the cost of that. Because now, if there's a settlement in the first year, they're going to kind of offset. So basically, your income, it's going to cut into your income regardless. But yes, sir.
Total $46 is going to be a loss of the lease.
Everything,
Fraction.
a fraction of it, less the premium on your tax return. So you get the benefit of that in year one or
Say we're proud of that.
yeah.
Yes.
Yeah, we usually expense it out year one, unless, unless the offering takes longer than a year. So whatever portion hasn't sold in that going into year 2, then, you know, we only expense that, we prorate it. So year 2, if there's like another 20 units that haven't sold, you'll get the benefit of that as well in year 2, but it's a lot smaller. Yes, sir. Sorry.
Company's fee, is that taken into consideration the initial call not offering up front, or are you guys keeping a share? Or how are you guys paid?
We make money 2 ways. We have a markup in the policy, so we have a percentage of markup on the cost of the policies for profit. And we have another company that Terry and I own that we take a portion of the death benefit at the very end. And so once there's a settlement, let's say 95% of it goes to the partnership, 5%, we keep 5% of the death benefit as a performance fee, you know, for us essentially. So that's really how, that's the only 2 ways we make money. And the up.
I see you're able to dispose.
What's half? The how much fee?
You take that's a ballpark.
I would say out of the 4.6 million, the upfront fee is roughly, it depends on how long it takes us to sell it. But if we sell it probably within the first 6 months, it's usually about $400,000. And I think if we go longer, it's going to be a little less. And the back end fee, it runs, you know, it's all disclosed in the PPM, but the back end fee varies. Some policies we take 0, some policies we can take more. A lot of it is we evaluate each policy, and if there is room for us to take a little back end, but still have, you know, the policy still provides a great opportunity for the investor, that's what we do. But there's several policies that we don't take any. You know, we just, and then there'd be one of the group that has a lot of room. We might take more of that. But we try to, we want to keep that return in about the 37 to 45% range if we can, the projected return, because what that does is it gives the investors a lot of room for error, So if they live longer than expected, that's cutting into your return. So we're trying to we try to design it to where at the maximum projected level, it's going to be high. Anything less than that, let's say they don't perform and you make 25%, it's still a good investment. Yeah. So that's our thought process. And just to elaborate on our company a little bit more is that we're one of the very few life settlement companies that use this model. I mean, most models are like a mutual fund where you put money into the fund, they're over here buying life settlements and paying premiums and selling some, and they resell them in the market, then they buy some more. So what they're hoping is they can create enough profit by that business to pay you a return, but there's no guarantee on the return, and it varies from quarter to quarter. So it's kind of like a mutual fund with a net asset value. It's always changing based on policies they're buying and selling. There's huge funds that do this, but we like the model of the way we do it because it brings you in as a member. You own the actual policies. You get the maximum benefit if they do well, and whereas in a fund that's just floating all the time, you never know based on each quarter, what your return is going to be. They may be buying policies, premiums go up, they're selling them, they have to sell them for less than they thought. Their overall profit is not as good. So we're one of the few companies that actually do this unitized member partnership model where you actually are a member who owns the policies yourself. Because as a member, you own the policies, your percentage.
To follow up, what's
Sure.
was year 2? I think that annual premium payments. That's what you a one with the deduction.
Yes, but not for the premium, only for the administration fee. The premiums are not, they're not they're not expenses.
Okay, well that's kind of like
Yeah. That's why I told you in the first year it's the offering less the premium, because the premium,
cost of my house or my car. I don't get any.
yeah, but it's,
At the cash out at the 108, like in your example.
but it does, but what it does though is increases your basis. So let's say the amount of premium you paid is going to be in your basis. So whenever you do get that final K1, it's going to pull out all your basis, and you're only paying tax. Yeah, you're only paying tax on the net over the premium. Yes.
But he said it was like one third. But the last 1/3 was pretty good. But do you ever have any goose eggs where people are sitting around and you get the guy outlived the
Yes. 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 I mean, we've got some of the older ones that we inherited when we bought the company that are single. They are single policy offerings. And we have, out of 105 that we manage, we have 2 that are already negative. In other words, they've put in 100,000 or 110,000 to get 100.
So there's a diversified group of multiple policies.
It's just, yes, that's one of the reasons that I went to the multiple policy model when I met Terry, was that it mitigates risk. The more people you have, obviously, if you have one outlier who just lives and lives and lives and lives and lives, good for them. God bless them. But that's going to be an outlier that hurts your return. So you got other policies that could go early or on time that are going to pay off well for you. So it kind of mitigates that. But we do have, to answer your question, we have a couple singles that it's a loss. It's not a goose egg. Yeah,
That's exactly.
yeah, it's a negative. I mean, because essentially, but you can't get out. That's the problem. And I've tried to explain this to our investors, is that, because think about this, if you've been in one for 11 years, I'm thinking one that we have. It's 11, 12 years old. You've paid $110,000 for your total investment. Your death benefit is $100. But if you quit, you're going to lose $100, the whole $110. Or if you stay in, you're only going to lose the 10. You only lose 10,000 versus 110,000. So I know then you go, woo, I'm only going to lose 10. But but yeah, we do have a couple of those that are in our portfolio that we inherited. None that we've done in the last 8 years, but been there. But anyway, yeah, there's always that risk at time. That's what I said in the beginning. Time is your only variable.
So playing with stock market, you don't buy one.
Exactly. Yeah, we try to, we tell people this. We meet a lot of people, investors. They'll say, "Hey, I love it. I want to put 250,000. I want to put 300,000 in." And we'll say, "Well, why don't you just put 100 in our current offering, and then put 100 in our next one, and another 100 in our next one? Because that way you're getting more bodies." I know it sounds morbid, but you're getting more people, more insured. You're spreading out your risk more. I mean, we could say, "Yeah, put the whole 300 in," but honestly, we feel like the more you can spread it out, it mitigates that risk. So that's our advice always.
And they see. Anybody employ turf policies?
Does anybody?
Going to the universal.
I'm sure there are. I mean, there's every hybrid of life settlements out there in the marketplace. So I'm sure somebody buys one. Coventry may buy them.
Does the benefit ever get challenged by the insurance company if it ever slow in getting paid up?
No. I'm an old banker. I kind of relate the insurance industry to the banking industry, where, when a bank fails, It goes into receivership with the FDIC generally. And what they do is find a new buyer. They don't let it collapse totally. And if they do, you know, then I actually worked for the FDIC a long time ago. And there was an instance where they had a payout. They just pay out the depositors, but they paid all the deposits and they closed the bank. So that way the depositors didn't lose anything. That's kind of worst case scenario. Best case is they resell the bank. So it's kind of what happens in the insurance industry. If there's an insolvent carrier, they also go into receivership and they find another carrier or carriers who will take that. Because think about it, much like the banking industry, you don't want people, the public perception of a life insurance company that I could be paying all this money in all these years and they go insolvent and I'm not going to get my claim paid, you know, or I'm going to lose my money. So I think in the insurance industry, they find another company. They don't want that public perception damaged, just like the banking industry. So, yeah.
So you already own these three policies, like do you buy them and then you give the investors or?
Yeah. Yeah. See, that's one thing that we differ a little bit too, is that we risk our own money. I mean, we go out and negotiate and buy these policies. We own them. I mean, our company owns them, and those carriers want that premium the next month. So we have to start buying. So we have to buy those policies, put our offering together as soon as we can, and then get it out to investors, potential investors, and start, you know, selling the offering. That's the only way we recoup our money.
So how long have you had this policy?
This offering came out in April, I think around maybe in the middle of March, 1st of April. And we bought these policies around the about this time about January last year. So we own them for
January this year.
this year. I'm sorry. Yeah. So we
May have a handful of share left.
we do. We're down pretty low on this one. Not that we don't have any. We do. We thought we were down to 0, but we found out that one of our institutional type investors, they put it on hold, and we said, well, we're not going to hold it for you. So anyway,
So if I go in today, am I paying from when you bought it originally?
no.
Paying just for like 2025? Like if somebody bought 6 months ago, I've never done paid them. We're gonna get this.
No, actually, you're a little better off buying it late. You know, I don't like to say that, but it really is the truth, because, you know, what happened is what's gonna what's gonna happen is that you're coming in. If you buy now, you're coming in now. So your investment paid the premiums for this past year, right? So we've collected your money. It's going to the year one premium. But since you bought late, Jennifer's not going to send you a bill for your capital call until later in the year, next year. You know, whereas the people who bought in April, May, June, they're going to get a capital call a lot sooner. So basically, time value of money, you're better off buying late. But
Pay the same.
you all pay the same amount. It's just when you pay it. Yeah.
Okay, let's give Dirk a big round of applause.
Oh, okay.
So thank you so much for coming today. Your contact information is all on the
Yes, I was going to
document.
also say, if you have an interest and you want information from us, you can see Jennifer and just give her your email, and she'll email you the information as well.
Great.
So,
Great. I
Yes.
think this has been really valuable. This is just something that not a lot of people know about, and it's incredible how much information there is available and the different options. So
I'm sure I left out, you know, there's a bunch of stuff, but we office just right off of Nolan up here. You're welcome to stop by our office anytime if you just want to dig deeper into anything.
Great. And we look forward to continuing Investor Club next year. We're going to target a specific day and time of the month, And so we're working on that right now. So be on the lookout for next year's schedule. So thank you very much, everybody.
Yes. Thank y'all. I enjoyed it.